Introduction to Forex Trading. Introduction to the module. The Forex market is at the center of the global economy. Whenever an investor wants to invest in a foreign country, a tourist wants to holiday abroad, or a consumer wants to consume a foreign-made good, a Forex transaction is needed. Yet the Forex market serves more than just the needs of these users. The market's depth, liquidity, and accessibility mean that it also offers ample speculative opportunities for those who wish to trade it. This module will explain what the Forex market is and how traders can seek to profit from it. What is Forex? Forex, or foreign exchange, as it is formally known, refers to the global trade in the world's currencies. It is arguably the largest and most important financial market in the world. This is because most international trade and investment also requires a currency transaction. Consider the following examples. A British tourist holidaying in France must convert pounds into euros, in other words, sell British pounds and buy euros. A Japanese retailer selling goods in the UK must convert foreign receipts, in other words, British pounds, back into Japanese yen. American investor buying shares in a German business must first sell US dollars and buy euros. A Swiss importer of Danish goods must convert Swiss francs into Danish krone to settle the invoice. Trade and investment flow between international partners who share the same currency, or where one party is willing to accept foreign currency, require no Forex transaction. The Forex market. Unlike the stock market, where financial transactions have historically been centralized at a physical stock exchange, the Forex market has always been decentralized. Currencies are traded between thousands of banks, in hundreds of countries, right around the clock. The value of daily transactions in this interbank market exceeds $5 trillion, which is more than that of the global stock markets combined. The consequence of this fierce competition is that the market is extremely liquid and transaction costs are typically low. Almost all national currencies are traded in the market. Most trade, however, is concentrated in just 6 currencies: US dollar, European euro, British pound, also referred to as sterling, Japanese yen, Swiss franc, Canadian dollar. The oldest actively traded currency pair is the British pound versus the US dollar, an exchange rate affectionately known as the cable. The nickname dated from the mid-1800s, when Great Britain and the US were the 2 largest economies in the world. The advent of the telegraph machine allowed currency transactions to be executed between London and New York via an underwater cable in the Atlantic Ocean. Forex transactions. A forex rate is the price of one currency expressed in terms of another. So, a forex transaction simply means exchanging one currency for another. Consider a forex rate for cable, the pound-dollar parity, of 1.25. This price means that £1 can be exchanged for $1.25. A trader can either sell £1 to buy $1.25 at that price, or sell $1.25 to buy £1. The forex rate is subject to change, depending on demand and supply. The value of the dollar might rise, for example, if US-bound trade and investment flow increase. In this case, the pound might fall, and the dollar rises, respectively. A pound might then only buy $1.15. Opportunities in Forex. The Forex market not only facilitates trade and investment in foreign assets, it is considered a class of asset itself. Consider the development in the cable exchange rate just described. Currency traders who anticipate a rise in the value of the dollar could exchange their pounds for dollars at 1.25. After the exchange rate falls, they could do the inverse transaction and rebuy the sterling. As they now only need to sell $1.15 to recover £1, they can pocket the difference as profit. Admittedly, this profit is only 10 cents. But, as Forex transactions are typically in the millions or tens of millions of pounds, those 10 cents quickly add up. Trader sells £10 million at 1.25 and receives $12,500,000. Exchange rate falls to 1.15. Trader resells $12,500,000 and receives £10,869,565. Return on £10 million investment is £869,565, or 8.7%. Fractions of a penny. Trading on margin. 10 cents, 8.7%, is an exceptionally large price change in the currency markets. The cable might only move 1 cent in a single day, sometimes only 1/10 of 1 cent. Given the small price moves, how can currency traders make significant profits without having tens of millions in cash for trading? The answer is leverage. For a fee, a currency trading service provider will allow traders to borrow the desired amount in one currency to sell in exchange for the other. The collateral for the loan is the amount in the other currency. A risk for the lender only arises if the exchange rate moves in an unfavorable direction, such that the value of the other currency no longer fully covers the amount of the loan. In anticipation of this, the service provider will ask for some additional security, known as a margin. Profiting and risks in Forex trading. A margin of 2% would allow a trader to deal in an amount 50 times larger than the capital investment. This allows even a modest capital investment to yield impressive returns. Let us return to our earlier cable example. Trader deposits margin of £10,000 and uses 50-to-1 leverage. Trader borrows £500,000. Trader sells £500,000 at 1.25 and receives $625,000. The exchange rate falls just 1 cent to 1.24. Trader sells $625,000 and receives £504,032. Return on £10,000 margin investment is £4,032 or 40.32%. Of course, had the price moved in the opposite direction, the loss would also be in the order of 40%. If the loss is so great that it threatens to devour the entire margin, the service provider would ask the trader to post additional funds, known as a margin call. If that is not forthcoming, the service provider would unwind the transaction. The trader would always be responsible for any losses, even in markets undergoing significant disruption. Why trade Forex? The Forex market offers traders several advantages when compared to other asset classes. They can be resumed as follows. Trading hours. The market is open 24 hours per day, 5 days per week. No structural bias. A Forex rate is just the price of one currency expressed as another. The rate can, therefore, rise or fall with equal ease, and a crash might just as easily be upwards as downwards. Opportunities. Traders can seek to profit whether markets are rising or falling. Cost. The market is highly competitive and very liquid. Commissions are negligible, and the difference between the buying and selling price, known as the spread, is narrow. Execution. The major currencies have deep Forex markets. A trading price is almost always available, and trades can be executed immediately. Leverage. Margin trading amplifies profits and losses according to the leverage used. Summary. The Forex market exists to serve the needs of international importers, exporters, and investors. However, a large part of the huge volume of daily transactions is purely speculative. Currency traders constantly try to profit from changes in Forex rates, upwards or downwards. Thanks to leverage, even the tiniest price change presents a trading opportunity. The Forex market is a decentralized interbank market. A Forex rate is the price of one currency expressed in terms of another. Forex rates can change 24 hours per day, 5 days per week. Margin trading allows traders to trade multiples of their capital. Leverage amplifies both profits and losses.